syllabus. I'm going to do like a little mini lecture right now. So it's really important. It's really important in understanding valuation work. It doesn't matter if you're valuing, stocks, bonds, real estate stocks, real estate bonds, real estate portfolios, mortgages, mortgage-backed securities. It doesn't matter, okay? Because basically the valuation methodologies are all the same. Perpetuity or growth, multiple approach, discounted cash flow. Okay, they're all the same. It's just you're using real estate and real estate securities as opposed to stocks and bonds and corporates. Okay. But the number one factor that drives prices of stocks and bonds up and down are interest rates. Interest rates. The Federal Reserve. Okay. So we like to talk about, in these books, particularly in your finance books, you usually have one little itty-bitty chapter, on institutions and central banking and monetary policy. You have like one little discussion. You're going to get that in your institutions class. You'll get more of that in institutions, and you got a lot of that in your macroeconomics class. Okay, so you assume that you already know that stuff, so that when you start playing with these models, basically the discount rate or the interest rate moves up and down arbitrarily within the book. Now the books don't do a good job, but I think that you have to know that you have to have a solid understanding of interest rate determination, okay? Central banking, okay? And the central bank, the Federal Reserve, along with the other 4 large central banks on a global basis, basically coordinate their monetary policy, coordinate their quantitative easing and quantitative tightening, coordinate their yield curve dynamics, and coordinate the asset prices of the stocks, bonds, and the real estate. Okay? They're coordinated to a certain degree. Yes, sir?
Right?
No, well, before the financial crisis, most of the global central banks were pretty autonomous. They were still coordinated, but they were fairly autonomous, conducting their monetary policy pretty much on their own, but still watching the United States, which is basically the dominant economy, the dominant capital market, and the reserve currency on a global basis. So everything really flows from the Federal Reserve here in the United States. So yes, it's collusion, it's not really corruption, but again, that's an ideological and a moral and a ethical decisions that we can have later. Okay. But the fact is that asset price bubbles, asset prices, real estate securities are determined based on macro systematic factors due to changes in interest rates, period. So if you can forecast where the economy is going, and you can forecast where interest rates are going, you can forecast where the value of real estate is going to go. Okay? And then you underwrite the actual real estate. Okay? But you got to start with a macro model. Okay? So the first thing I start off with is I have 3 lectures here that basically talk about yield curve and yield curve dynamics. And if you have your computer with you, you want to type in dynamic yield curve. And I actually have the URL right there, the PhD. So here's the dynamic yield curve. It's on stockcharts.com. And I've been studying this stuff seriously for like the last 10 years because the financial crisis was a major event. And I spent the last 10 years figuring out the origins of the financial crisis so that I could be able to predict the next financial crisis. Do you think that would be valuable to know when the next recession is going to be? Yeah. Because I get asked all the time. It's like, Professor Souza, Dr. Souza, when's the next recession going to hit? What should I be doing right now? Should I be buying the house? Should I be buying this property? Should I be selling them? Should I be selling my stock? Should I be selling my bonds? What should I be putting them into? Because I'm an investment advisor too. So I get that question all the time. So here is the yield curve, okay, right here. And then right here is the S&P 500 index. Okay, and the S&P 500 index, which are stocks, are leading indicators. Because people aren't pricing stocks based on today's earnings or historical earnings growth. They're basically pricing the stock based on earnings projections 1 year from now. So the stock market is forward-looking, it's a leading indicator. So this is basically the S&P 500 index since basically 1999, okay? 99, 2000, we were in a recession in 2001, 2, 3. We were in a recession, 8, 9, 10, and we've been basically in an upward trend ever since then, okay? And a major trend, right? Because here's the support line right here. We broke through the support line in 2012, and the stock market's only been going up. Why? Anybody want to tell me why real estate prices and stock prices have been going up? Basically, you know, on a tear.
Interest rates are so low.
Because interest rates are so low. And why are interest rates so low?
Because of the big crisis we had.
Okay, because so there could be deflationary, inflationary expectations embedded in projections of interest rates. But what else is causing the interest rates to remain low?
Whoever controls the interest rate.
And who controls the interest rates?
Federal Reserve.
The Federal Reserve. So does the Federal Reserve print money and buy bonds? Yep, to stimulate the economy. So they'll print $5 trillion, which they did, bought up a bunch of government securities to drive up the prices and drive interest rates down. Okay. And it wasn't until recently that they stopped doing that. And the money supply now has slowed. It was growing at about 30–40% in the crisis. Down here, it was growing at 8 to 10%. In here, like 14–15, and now it's down to like 2 to 5%. So when you start to see money supply start to shrink or start to slow, it's going to impact the real estate and the stock market at some point, because the liquidity is being pulled out of the marketplace. Okay, so let's get back to it. So the yield curve. Can somebody tell me what the yield curve is? And you are now the most powerful generation.
How many years?
Right? Hold on. You're the most powerful generation. You have a computer in your hand, supercomputer. You have laptops, tablets, everything in your hand. When I say, do you know what a yield curve is? You should look it up on your computer. Right? Because you can. In 1992, when I started in my job, we had computers, but we didn't have the internet until 1998. And it wasn't fully adopted until like 95. Right? Right? And we were using it. Yeah, we were using it a lot, you know, in 2000, you know, in 2003 and 5 and 9, right, and now to today. So now you can find the information. You should be active looking for the information, because now when you're sitting in a meeting, they're going to be asking you questions, and if you don't know the answer, they're going to expect you to look it up on your computer, your tablet, your cell phone, and not only will you have an internet to find it, but you'll also have an extranet, an internal internet, to pull internal data and information from the knowledge base, the ERP system, your knowledge base system. So now you can pull information from the internet and internally to have the discussions in the conversation, in the moment right there, and resolve the issue, figure out what the problem was, figure out the solution, and go do it. It's not like I'll get back to you in 2 days anymore, because you can get the information in 2 minutes. So now we can do the research. We've got the problem, we can do the research, we debate the solution, we figure out the solution, and now we go do it. There's no wait time, we've collapsed it. Yes, sir.
Do you still want an answer for it?
Yes, tell me what the yield curve is.
The yield curve plots the interest rate at a given point in time.
Close. The yield curve, you're right, given point in time today. Okay, what is the interest rate on given government, U.S. government securities, risk-free securities today? What is the interest rate by maturity? Today, by maturity. Okay, so we've got what? 3 months, 6 months, 9 months, 1 year, 3 year, 5 years, 7 year, 10 year, 20 year, and 30 year maturity bonds. Okay, we got the 3 month, we got the 6 month, we got the 9 month, we got the 1 year, we got the 3 years, 5 years, 7 years, 10 year. In the 10 years, the number one interest rate were all mortgage securities and all interest rates, loans, personal loans, mortgage loans, everything's benchmarked off the 10-year treasury. And then you have the 20-year security, and you have the 30-year security, and you got yield to maturity, or the interest rate associated with those bonds at that maturity. Okay? And any bond that's less than 1 year is the money market. Anything more than 1 year is considered the capital markets. Okay? Now what we're going to show you in a minute is that yield curves move up and down. Okay? Yield curves can shift up, and yield curves can shift down. Now the equation for nominal interest rates is the Fisher equation. And the simple Fisher equation, after Irving Fisher, brilliant guy, did multiple models, did not only the interest rate model, you basically get the interest rate model, but also the quantity theory of money, which is basically the theory of transactions. Another just brilliant philosopher. So the Fisher equation states that the nominal interest rate by maturity is equal to the real rate plus inflation expectations. I remember these days when I did CHOP. I would come home just sneezing and dust all over me. So, not inflation, but inflation expectations. Okay. So these nominal interest rates are determined by the real rate, which is basically the rate that the investor would require under a zero inflation regime, in zero interest rate environment.
Can you say that one more time?
Yeah, so the real rate of return is the minimum rate of return, the minimum required rate of return, the minimum real rate of return the investor would require in an environment of zero inflation. Okay, it's the minimum return. Okay?
That they would like, or
That
make
they would,
money, or
I'm an investor, I'm going to invest in bonds. I'm basically lending money to the federal government when I buy their bond. When I buy the bond, it's like, hey, you guys got to compensate me. I want not only a real rate of return, but I want to be compensated for the deterioration in my purchasing power due to inflation. So I want to be compensated not only for my real rate, but also inflation. Because if inflation goes up, over time, let's say 3% a year, the purchasing power of the coupon interest that's coming off the bond along with the principal that I get paid at the end is deteriorating in value due to inflation, the deterioration of my purchasing power. So me, as the lender to the government, I say I want a real rate of return and I want to be compensated for inflation. Okay? So the nominal interest rates is the real rate plus inflation expectations. Now real rates are relatively constant in the short run. So really movements in interest rates come mainly through changes in inflation expectations by the bond market, by bond investors. So I think that the economy is going to overheat. What was the economy, what did GDP grow at in the last quarter? What was GDP? Do you have computers? Do you have handhelds? Do you have tablets? You could probably type into your Google GDP in, what was January, March, April, May, June, second quarter of 2018. The Commerce Department popped up. What was GDP?
2.2.
2.2? Are you sure? That's a little low. Is that the second quarter of 2018? Is that right? Any confirmation or validation?
It says 2.2.
2.2?
That's it. Well, gross domestic grew at a solid 4.1% pace.
And then what did they say for the real?
You might take it back, take it back.
Okay, was it 2.2? I thought it was higher. What was it in the first quarter? What was it? 4.1? Okay. What was it? What?
Down to 2.5, PMI's dropped.
So what was it in the first quarter?
It was 4.1 last quarter, sorry.
Oh, what, 4.1 in the second quarter?
It increased by 4.1%.
Got it. 4.1, got it. 4.1% GDP. The long-term potential, the long-run average of GDP growth rates since basically the 1960s, we can go back to the 1940s, has basically been 3%. So is it higher than the long-term average? So it's growing above the trend. So if GDP is growing above the trend, would that be inflationary or disinflationary? Well, if the economy is growing faster than the long-term average, faster, it would be inflationary. So what would inflation expectations do? If the economy is growing faster than it should, would it be inflationary? Yes. And if it looks like it's inflationary, what would inflation expectations do? They would go up. And what would interest rates do? They go up. Get it? And what was the CPI index on the Bureau of Labor Statistics website? What was the CPI index, annualized, reported last month? It was what, like 2.9%? It was like 2.9%. This was actually the consumer price index, the CPI. It was 2.9. The Fed is targeting inflation at 2%. Is this higher than the Fed's target? Is this higher than the Fed's target?
Yeah.
Is GDP growing faster than long-term trend? Is it inflationary?
Yes.
Would inflation expectations go up? Would interest rates go up? Got it. What if the GDP was 2%? Is that inflationary or disinflationary? Disinflationary. If the CPI came in at 1%, would that be inflationary or disinflationary? Disinflationary. So what would inflation expectations do? Would it go up or down? It would go down. And what would interest rates do? Go down.
So what does that mean for the overall?
Because the theory is, if I'm going to take, let's say, the coupon on the bond, say I'm just looking at the coupon, and I think that interest rates are going to go up, what's the value of the bond going to do? If interest rates, because inflation expectations are going up, interest rates go up. If interest rates go up, then the value of the bond goes down. That's why it's important. I can take this coupon and I can change it to dividends or a stock. If interest rates go up, if inflation expectations go up and interest rates go up, and if interest rates go up, our expected rates of return go up, what happens to the value of the stock? It goes down. If inflation expectations go up and interest rates go up, and I change this to net operating income for real estate, if my income capitalization rate or my expected rate of return goes up due to higher interest rates, what's going to happen to the value of my real estate?
It's going to go down.
It's going to go down. So at the end of the day, everything is related to monetary policy, using the Fisher equation, inflation expectations, economic indicators, inflation, economic growth. It's going to determine inflation expectations that will determine interest rates, and the direction of the interest rates, either up or down, is going to determine the value of the stock, bond, and real estate.
So are you saying that they have to be near expectations in order for there to be like consistent growth? Like if it's over what they expect, like are you saying there's going to be like a correction? Like there has to be a correction?
If the GDP is running hot and inflation is running hot, then inflation expectations are going to go up, and interest rates are going to go up, and the Fed is also going to be selling off bonds, driving down bond prices and driving up interest rates to cool the economy, to limit the deterioration in purchasing power due to inflation. So the Federal Reserve basically stimulates the economy through open market operations by printing money or buying the bonds to basically either drive bond prices up and interest rates down to stimulate it, or sell the bonds to drive the the bond prices down and interest rates up to cool the economy.
I was gonna say, don't they pretty much control it? Like,
They control it.
they're deal.
Yep, yep. But so the theory here is that all asset prices are determined by Federal Reserve monetary policy. That's it. Okay? Yes, the underlying economy and the underlying fundamentals of the real estate and the location and jobs, and demographics and that stuff, yes, has a factor on the real estate, but at the end of the day, the number one factor that drives real estate prices up and down is monetary policy, the yield curve, inflation expectations, interest rates will determine the value of the asset. So here's the deal. So if inflation expectations go up, then the yield curve shifts up. The yield curve and interest rates shift up, then the value of the stocks, bonds, and real estate go down. If the inflation expectations go down, interest rates go down, the yield curve shifts down, the interest rate and the expected returns go down, and the values go up. So the valuations, the value of stocks, bonds, and real estate, and derivatives and other asset classes, at the end of the day, starts from monetary policy and the yield curve.
You said the payments go down, if the interest rates go down, the payments also?
If the inflation expectations go down, interest rates go down, expected returns and interest rates go down, and the values go up.
How does it drive the value up if the expected returns are
Because
going?
the discount rate, the interest rate, the expected return goes down. So this is just a mathematical formula,
You're divided by the smaller number.
right?
Okay.
So this is 1,
Okay.
right, divided by 10,
Oh, okay.
right? If this goes up, that's going to go down.
Okay.
So interest rates determine return expectations, the base rate. So everything is determined at first based off of interest rates. Interest rates are determined mainly, movements in interest rates are mainly determined by inflation expectations. Okay, so higher inflation expectations, higher interest rates, valuations go down. Lower inflation expectations, interest rates go down, valuations go up. So if inflation expectations go up, interest rates go up. If inflation expectations go down, interest rates go down. Got it. So basically valuations of these asset classes can be determined just quickly based on the Fisher equation and upward and downward shifts in the yield curve. But the yield curve is not static, it just doesn't shift up and down. It actually does other things, okay, which is even more important. Because the Federal Reserve basically controls the short end, short-term securities, the short end of the yield curve. The yield curve is segmented by short-term, medium-term, and long-term. The market segmentation hypothesis. So liquidity preference theory. Okay. But the Federal Reserve only controls short-term interest rates through open market operations out of the Federal Reserve Bank of New York. Okay. Monetary policy, open market operations are conducted through the Federal Reserve Bank of New York. Okay. And basically the Federal Reserve Bank of New York basically buys and sells bonds to drive bond prices up and down, to drive interest rates up and down, to either cool or stimulate the economy. Okay. That's their role. So what's happened over the last year almost, okay, because the economy has been in the growth phase of the business cycle and towards its peak within the business cycle for so long that we're starting to see inflation pressure in wages and in commodities, for one. And the Federal Reserve decided over a year ago to start unwinding the $5.3 trillion of mortgage-backed securities and treasury securities to unwind the quantitative easing that they had done over the last 9 years. And the majority of the bonds that sit on the Federal Reserve's balance sheet, the treasury securities, at least 1.2 trillion, are short-term government securities. So we're starting to see higher inflation expectations, which is driving short-term interest rates up and is flattening the yield curve. And since the Federal Reserve is unwinding the 5.3 trillion, the balance sheet that they basically had printed money and bought all these bonds. Now they're unwinding and selling the bonds. And most of those bonds that they're selling are short-term in maturity, which is causing short-term bonds prices to go down and interest rates to go up. So it's the double whammy. We're seeing higher short-term interest rates from higher inflation expectations and an unwinding of the balance sheet by the Federal Reserve. And we know that if short-term interest rates are going to go up, those short-term securities under a rising interest rate environment, the values are going down. Are you happy if you're a short-term bond holder that interest rates are going up and the value of your bond portfolio is going down? Are you happy about that? No, because they're destroying your wealth. Okay, the value of your wealth is going down now. So here's the deal. This is the deal here. And a lot of these real estate mortgages, were not fixed mortgages based on the 10-year treasury. They were basically floating rate mortgages that float with the shorter maturity securities. So as the interest rates start to go up, their payments on their mortgages start to increase. And the cash on cash that they had before is now starting to shrink. Their profits, their return on equity is now starting to shrink. And this is what could happen, and this is what we've been talking about for the last 6 months, and I've been talking about it for a long time. Because I've been watching the yield curve start to flatten. Okay? What happens usually at some point, and this is what we've been talking about, and actually the curve is already inverted in some emerging bond markets, and is already inverted on some of the swap curves. The curve inverts because the Fed oversells the securities because they make a mistake. They oversell the securities and they invert the yield curve. Once the yield curve inverts, the stock market peaks in less than 12 months and we're in a recession in less than 24. It's been proven since 1960. People have gone back 150 years, post-World War II, 1955. The yield curve is the #1 predictor of recessions. And what's the value of your real estate going to do when interest rates start to go up significantly? Go down. What happens to the value of your real estate when you go into a recession? Go down. Okay. So is it important to understand the yield curve and its dynamics and monetary policy? Absolutely. And they're in Jackson Hole, I think, today. And Jerome Powell is basically talking and saying it looks like the interest rate path that we've been on over the last 6 to 9 months will continue, and we will probably raise short-term interest rates another 3 to 4 times by the end of this year, but definitely by the end of next year. And right now, the difference between the short-term yields and the long-term yields is only 25 basis points. It used to be a lot wider. Now it's really narrow. So if the Federal Reserve raises interest rates 25 basis points one more time, the curve is totally flat. If they do it 2 more times, they invert the curve. And then this is what happens. You hit animate, and it's going to show you the yield curve, and it's going to show you the stock market. So this was in 2000. The yield curve was really high, and it was flat because we were moving towards the peak of the stock market and peak in the economy. Now watch it. Once it approaches the peak, it's going to invert. Watch. Boom, 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 boom. Inverts. Okay? And then all of a sudden, bam, 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 we go into a market correction and into a recession.
So are you saying the market's in correction?
Watch. Just wait. Just wait.
Just
Just wait. So then the Federal Reserve starts to print money, buy bonds. Yeah, I am saying that. The Federal Reserve is now basically printing money, buying bonds, driving up bond prices, and driving down interest rates. So now the curve is extremely steep, it's upward sloping, and it's a normal curve. And they're buying, driving up the bond prices, keeping the interest rates low, buying. You can see how steep it is. And then what they do is, at some point, they'll start buying the longer dated maturities that flatten out the curve to bring down the cost of borrowing for plant equipment and real estate financing. Okay? So now we're moving back up towards the peak again. As you can see, the yield curve is starting to flatten. Short-term interest rates are moving up. Watch this. As we start to approach the next peak in the 2006-07, oh, did it just invert? It's definitely flat now. Watch it. It's going to invert. There it is, done. Boom. And in this case, the stock market peaked about a year later, less than 12 months. And where were we in 24 months? Recession. Okay? So the yield curve, everybody's watching it, everybody's talking about it. I've been watching it, I've been talking about it for at least 2 years. Now it's on everybody's radar screen because it started to flatten and it's becoming an issue. And people are saying, along with Uncle Donnie Trump, is now telling the Federal Reserve, do not invert the curve. Stop raising interest rates. You're going to blow my cover to get the House and the Senate again, and my presidency for the 2020 election if you send us into a recession. Do not invert the curve, is what he's telling the Federal Reserve.
That's
So
a
what do we
fool
do?
though. It's bigger than him. It's bigger than him. It's a whole.
Well, exactly, because the Federal Reserve will lose its independence and its credibility if it listens to the executive branch for monetary policy. So here we go again. So this time around, in this last recession, they drove short-term interest rates to 0. And in Europe and in Japan, they drove nominal interest rates negative. So imagine if you were a saver or a bank that needed to buy short-term securities for liquidity purposes and the yield to maturity was negative, would you be happy about that? No, because the banks has to pay depositors a positive interest rate, but they're investing in short-term government securities that are providing a negative interest rate. So it's eating into their profit margins and restricting their ability to lend on real estate mortgages. It's not working. It's disintermediation.
Then who wins off that?
Who wins off what? In negative interest rate environment?
Yeah.
People who basically have owned the bonds at high interest rates. And as the interest rates go down, the bond prices go up. Those people win. The people who buy the bonds at the negative interest rate, and as interest rates start going up, the value of their bonds go down. It's the people who buy the negative interest rates lose. The people who owned it before win. The people who bought them in the negative or in the 0 range lose.
But they don't even tell people that, do they?
No, you got to figure it out because you're an econ major. Okay. And as you can see, the yield curve is still extremely low. It's starting to flatten. As you can see, the short-term rates are moving up. It hasn't inverted yet. It hasn't inverted yet.
So we got how much time we got?
Well, you do the theory. You do the theory. Do the theory. So if the yield curve inverts and the stock market peaks in less than a year and we go into a recession in less than 24 months, if currently the yield curve is flattening and looks like it may invert due to guidance by the Federal Reserve to potentially invert by the end of next year, when would the stock market peak? If the curve inverts at the end of 2019. 2020. When are we going to be in a recession? 2020.
All right, so we got 3 years.
No, I've been seeing that for years. Because the theory basically plays it out. Nobody wants to hear it.
It already, I mean, it happened twice right there already.
No, and you can go back to 1955, you can go back to 45. It's worked every frickin' time.
It's a trend.
So that's the first part of the class, is basically a lecture on yield curve dynamics, because basically yield curves determine interest rates. Interest rates determine mortgage interest rates. Mortgage interest rates at the end of the day, because real estate is so highly leveraged, has a leverage effect. And as interest rates move up, the cost of capital goes up, the cash flow and the coverage goes down, and if you default on the mortgage, the bank is going to foreclose on your property and is going to take it. Okay, we'll take your property. So interest rates at the end of the day are going to regulate not only the demand side, the rents, but also your cost of capital. So at the end of the day, interest rates and monetary policy determine the value of stocks, bond, and real estate. So you need to understand monetary policy and yield curve.
That's kind of discouraging.
Well, it wasn't discouraging in 2009
Well, no, I'm not saying
and 10.
it's your fault. It's not your fault. It's just discouraging to know
That's just
that
the way it
the
is.
potential is.
That's the way it is. So the yield curve lectures are there. I need to talk about yield curves right off the bat, okay? Because it's the most important thing. And as you read through the books and you read through and you start doing the pro formas, the expected rates of return, which have the interest rates embedded in it, are assumed. Okay? We're not doing scenario or dynamic modeling under different interest rate regimes or monetary policy regimes in most cases. It's usually static. And we usually run, if we're going to run the valuations, we run it under 3 discount rate scenarios. High interest rates, median and current interest rates, and lower interest rates. If we think that the economy is going into a recession, then we're probably going to use a lower interest rate environment. If the economy is going to continue to boom, then we're going to use a rising interest rate environment. And then stress test the pro forma modeling to see what the valuations look like. Okay, so that's basically that's why I always start with this, and I will probably ask you that on the exam. Okay, I will talk about draw out the curve, show me a flat inverted curve, talk to me about different theories of yield curves, which I'll go over a little bit more. And then if interest rates, inflation expectations go up, what's it gonna do to the yield curve, and what's it gonna do to short-term interest rates? And if the curve inverts, what's gonna happen to the stock market, what's gonna happen to the economy and real estate prices in the next 12 to 24 months? Because people are gonna...
Talk about this more.
I will. Yeah. Tonight's the first night, right? I can only cover, like 5 years of your education.
Come on, I was expecting you to pass
Went
talk.
over the syllabus.
And then on Thursday the 30th, which is next week, you guys are going to come back and be able to make the presentations, teams 1, 2, 3, and 4. Yes? No?
I'm team 6. So.
Okay. So teams 1, 2, 3, and 4, you guys have your chapters. Okay. The chapters are really easy. They're not really hard. Okay. But this book is pretty easy. The second book, here's the other one. Here's that one. Now that one's a little bit harder. You have to put your academic hat on that one. And then this one's a little bit, not easy, but not hard. And then this one's a little bit harder. We just depend on that one. If you want to email me the PowerPoint slide to let me take a look at it, I'll give you some feedback on it.
Or we can just send up our laptop and then...
Yeah, absolutely. Yeah. You can just hook it up. Okay. Yes, sir.
So it has to be 15 to 20 minutes long, right?
I'm going to leave it up to you, to decide. Obviously, you want to make it concise. You want to basically not read from the slides, but talk from the slides. Put the major takeaway, at the front, right after the cover page. Maybe you have the cover, the major takeaway, the outline, get into the presentation. It's the major takeaway. That's it. That's kind of the format, because in business, we don't wait to the very end of the PowerPoint presentation to tell you the recommendation or the key point. You just give it to us. This is what we're going to talk about. This is what we learned. This is what you should know. Let me just build the case, blah, blah, blah. Hit them again at the end, and that's it. Any questions? And the chapters aren't very long. Okay. And you're working in teams of 3, so you should be able to review each other's work and give some feedback and stuff like that. Okay? Is that okay? Okay. All right. So what time is it? I think I'm done. I'm done. You guys are awesome. You guys are awesome. This is going to be a great class.